All right, we'll let everyone filter in here. I think everybody's getting on. I'll go ahead and do a brief welcome for everybody, and then we'll get started with our program here in just a moment. So welcome to Preparing for What Comes Next, Thoughtful Approach to Business Transactions. Today, we have a talented and experienced panel of specialists in 3 key areas of the exit planning process. I'm going to introduce each of them in just a moment. I'm Jimmy Trimble, shareholder of HB, and along with the rest of our business development group, I lead our firm's organic growth efforts. Today, we're going to go through 3 key areas of the exit process. Pre-exit planning, during the transaction planning, and post-transaction planning. We're going to have a poll question for each one of those sections, which Elise will pop up in just a minute. You'll see that on the left side of your screen in just a minute. And then we will allow you a minute or so to answer that poll. I'm going to give a very brief introduction to our 3 panelists today, and then I'm going to let each of them do a little bit more of a detailed intro where they describe their day-to-day and their role in the transaction in the exit planning process. So first we have Kelly Nowotnick, who is also one of our shareholders here at HB Wealth. She's a senior wealth advisor and shareholder here at the firm. Kelly brings a legal background and over 15 years of experience helping families and business owners navigate major wealth events, everything from business sales to inheritance to generational planning. Welcome, Kelly. Charlie Yates is next, partner at Alston & Bird here in Atlanta. Charlie is an attorney focusing on complex corporate transactions, M&A, capital raises, and governance. He spends a lot of his time advising companies through high-stakes transactions. And rounding things out is Don Brivaldo, president of Brivaldo Capital Advisors. Don founded the firm in 2010 and has led over $250 million in transactions, working closely with founder-led and family-owned businesses throughout the M&A process. So now we're going to get started with a quick polling question, which Elise is going to put on the left side of the screen here. So if each of you would take just a minute to answer that question, we will get started. On the left side, if you hit the poll button, then your poll question should pop up there. There is, under the first one, poll pre-exit planning. If you'll click that little red box, you'll see there's a question there. It says, how far along are you in preparing your business for a future sale? So if each of you would answer that question, we'll give it about 60 seconds. All right. Looks like a close race between haven't started yet and doing some planning, but no formal steps. No one yet with the advisors engaged.
I read this as good news. There's lots of planning opportunities.
Yeah. Looks like we have the right audience. Good. As we wait just another few seconds for anyone else who would like to vote, I wanted to mention also at the end of the presentation, we did not plan a Q&A session for this particular session. We did take your questions before that you entered in the registration process, and we'll ask those questions and let our panelists answer them. If you have additional questions that come up, which you may that may result from this presentation, please reach out to your HB advisor, and they'll get you in contact. They'll connect you with the right experts on the panel today. All right, so before we get started, Kelly, then Charlie, then Don, would you please give a brief intro about your role and how you engage with individuals considering going through the exit planning process and going through the exit planning process?
Sure, I'll kick it off. Thanks, Jimmy. My name is Kelly Nowotnick. As Jimmy said earlier, feedback, I'm sorry. I'm a senior wealth advisor at HB Wealth. I, like Jimmy, I'm a shareholder in the firm, so very, very thrilled to be at HB Wealth, but I started my career in the practice of law. So I started in a trust and estate group in a large national law firm, working with families of wealth, many of whom were entrepreneurs. And I pivoted after about 6 years in that role. I pivoted 12 years ago to wealth advisory in the family office space. And the advantage of my role now is that I'm not working with families on a more transactional or discrete basis, but it's continual and ongoing. So I'm always sitting on the same side of the table as the families I work with, giving them continual guidance, advice, coaching, whether that's through going to market or a liquidation event, or if that's post-sale, thinking about what to do with all that liquidity and how to bring the next generation in, and wealth transfer strategies, investment placement, all of the above. So thrilled to be at HB Wealth and thrilled to be on this webinar.
I'm Charlie Yates. As Jimmy mentioned, I'm a partner at Olson & Bird in Atlanta. I'm in the corporate transactions and securities group, so I'm an M&A lawyer. And what that means at its base is that I spend most of my days working with folks like yourself to help you prepare to sell your business or sell your business. On the other hand, I may be working with the companies who are looking to acquire your businesses as well, so I know their tricks. I've been doing this for about 15 years, and like Kelly, I advise people through all stages of the process. So beginning from when you start to think about selling your business, through signing an LOI, through getting a purchase agreement done, and then on the back end as well, helping with earnouts, seller notes, really anything that comes up during your affiliation with whoever has acquired your business. Love doing this, love helping people out like yourselves, and looking forward to a great discussion today.
Great. And thanks, Charlie. I'm Don Bravaldo, president of Bravaldo Capital Advisors, which is a boutique mergers and acquisition, as well as corporate finance advisory firm. And that's kind of a mouthful, but it's very simple what we do. We advise private, closely held family-run business owners on the buying, selling, and raising of capital for their businesses. And within those three service lines, we do focus on actually selling a business and making a market for the business. A little bit about my background personally. You can call me a long ago reformed CPA that got some great training at Arthur Andersen and in the Big Six at the time, and finished up at a regional accounting firm, which I think gives me a unique skill set. And we have several former CPAs on staff here. Basically, I think what makes us unique and differentiates us from a lot of investment bankers that go to Wall Street is we've really had the opportunity to see financially what makes a business tick, how to put together the financial statements that everyone relies on to purchase a business. And it also gives us a unique insight on how to assess risk and to advise private owners on how to de-risk their business, all of which are very important. But the primary reason business owners are hiring us is to make a market for their illiquid business assets. And we do that very, very hands-on consultative approach that creates a competitive auction style confidential sales process that helps our business owners maximize value and get the best structure and terms for their business.
And Don, you just answered a lot of this question, but to whatever degree you need to fill out a little bit more of what the role does. What does a transaction advisor actually do? And when is the right time to bring someone like you in?
Sure. And I think there's a couple more comments there. And I will highlight that the differences in an advisor, you can call it an investment banking level of service in M&A or an M&A advisory level of service versus a broker. One function of an advisor is to bring a buyer to the table, right? We do that all day long. In fact, we bring multiple buyers to the table, but we advise our business owners. And in fact, to answer simply the question of when, we're ready to meet business owners 3 to 5 years in advance of a transaction or prepping for a transaction. And quite frankly, there are some business owners that we meet very, very early on. I mean, relationships that span a decade or more. And, it's unusual to meet someone who on day one starts with the end in mind, but they do exist, right? And those have been some of the most incredible business owners to work for because we get to know them 10 years in advance of a sale, and they consult with us at every pivotal juncture. And every business owner is going to have those, whether, it's never growth in a straight line. There's always plateaus that get reached, and there's always pivots that need to take place in business. And, consulting with us on the impact of the value of their business and the marketability of their business. If they do X, Y, and Z, what's our opinion about that? We love doing that. And I think any high quality advisory firm would. Contrast that with a broker who, I like to put it this way. It's a way to sell a business, but it's not a way to maximize the sale of the business. And quite frankly, reduce the risk of selling a business in the process.
We need to work with you on a couple, and appreciate all that you put into it. I just want to mention to the audience, thank you for your feedback on the sound feedback that we're getting. I think we've made some adjustments now, so that should be good, but we'll continue to update it. Please send additional messages if we do have other feedback. So Charlie, similar question to you. When's the best time to bring in the M&A attorney? I know that's a very general question, but maybe just share some thoughts on that.
Yeah, in general, I would say the earlier the better. The faster that you get your advisory team in place, the sooner we can start addressing the things that need to happen to make your business more saleable. Give an example of something that I saw recently. We had a client who bought a business a couple of years ago that was very much not tax optimized. And over the course of the transaction, we had to jump through a bunch of hoops that we shouldn't have had to jump through to help them with their tax situation. And then post-transaction, there have been continual tax problems that have popped up. And I would say that if that business had had counsel and a solid accountant in place, as well as an investment banker to kind of counsel them running up to their sale process, they would have identified that, been able to nip it in the bud. I think that their problem was bad enough that they would have still had an issue, but it wouldn't have been near as problematic as it wound up being. And so, bring in experienced counsel, bring in an experienced investment banker, bring in CPA. Make sure that your business is in good shape before you go to market with it, and you can avoid a lot of heartache on the back end.
Yeah.
Along those lines, thank you, Charlie. And along those lines, how early should owners think about the estate and tax planning process? And what's an example, or what are some examples of things that can go wrong if they wait too long?
I'll take that one. I'm not sure what to do about the feedback. I apologize in advance. One, all business owners are thinking about planning earlier than they might even understand, because when you choose the structure of your business, that really can be a tax planning decision, whether you're a sole proprietorship or a partnership, an S Corp or a C Corp. Those all have long-term planning implications. Not that you're married to that structure from day one, but you're already making long-term planning decisions. As far what most people mean when they think about estate planning in this context, it's wealth transfer planning. It's transferring an interest in your business to family members or trusts for the benefit of family members. How soon do you do that? Do you wait till there's an LOI in hand to start thinking about that? Or are you thinking about that weeks, months, years ahead of that? From my perspective, which I'm going to say is a tax efficiency perspective, we don't love to always have the tax tail wagging the dog. Every family's different, and certainly your family situation will dictate much of this. But from a tax efficiency standpoint, we would love to see you thinking about transferring interests in the business 2+ years ahead of having an LOI in hand, understanding that you don't have a crystal ball, of course. But the reason I say that is because you'll get the most valuation bang for your buck by transferring interest early, before you're going to market, before there's an LOI, and you will have filed your federal gift tax return disclosing the wealth transfer event before you have that LOI in hand, or you have a binding sale agreement, so that IRS, when they're blessing your gift tax return, won't have the benefit of hindsight of the actual sale transaction. So from a tax efficiency standpoint and getting the most assets out of your taxable estate using the least amount of your exemption, we would love to see people thinking about wealth transfer 2+ years ahead of an LOI. But if that window is already closed for you, certainly it's not too late to start thinking about estate planning. You can transfer wealth at any time, even post closing. And we've seen people be really efficient with valuations there by transferring, rollover equity in NewCo, if that's part of your deal structure, to trust vehicles and getting a lot of valuation bang for your buck with that strategy.
I'm just going to echo
Thank you,
Kelly's comments there. Charles and I both really want to emphasize getting some of this tax and estate planning accomplished multi-years in advance, instead of waiting for the transaction environment. Because I can promise you there's nothing more difficult than trying to explain to a buyer in the 11th hour a very complicated tax structure that now has to take place, and why they're going to be buying some stock from an entity they hadn't counted on. And it's a quick way to really unnerve a buyer and mess up a deal. And then maybe one other quick comment, and I'm sure the other panelists would have comments as well. It all starts with having the right team. And quite frankly, the people represented on this webinar today are great people to start with, but they're certainly the right categories where the owners of businesses really need to evaluate, do they have the right team already? Do they need to get more sophisticated help? And 9 times out of 10, if they really are willing to start from scratch and ask the right questions, figure out, have some education about the potential value of the business, I think it will lead to potentially at least needing some additional help in addition to the long-time advisors that exist. Because I don't think anyone here wants to replace, a 30-year knowledge base, for example, in the legal world, but that owner absolutely would benefit from having a solid M&A attorney with 30 years experience doing deals as opposed to other things.
And to build off that a little bit, going back to what Kelly said, I mean, the best time to start with estate and tax planning is now. And if you can't get it done now, tomorrow. You know, and if you didn't do something 2 years ago that you should have done then, don't wait until next month to do it. Go ahead and begin. Because as Don pointed out, a great way to unnerve a buyer is to say, yo, you know, we just made this transfer a month ago and we can't really explain to you why we did that. And that just gets very unnerving and, you know, invites a lot of questions you may not want to have to answer.
No, I appreciate that, Don and Charlie. Great follow-ups to Kelly's comments. And Don, I'm going to come back to you in just a minute about the biggest factors that influence value these days. But since you very appropriately took it in that direction, Kelly, a quick follow-up to Don and Charlie's comments. Clearly, before you get evaluate, you want to be pre-valuation before you start doing the planning. Clearly, after you get a value, after you receive the LOI, letter of intent, it's too late to do a lot of the value add that we can provide. How far in advance is it generally recommended? It's not the day before LOI, it's not a week before, you know, what would you say, just a general best practice?
Yeah, I would say a general best practice. And again, family circumstances should always play a role here. We shouldn't just be looking at tax efficiency. But for these purposes, because there's lots of folks on this call and I don't know everybody's family circumstances, I'm just going to speak from a tax efficiency standpoint. You know, as soon as you start thinking, wow, this business is really growing, look at these EBITDA numbers, like we could find ourselves in a situation, whether it's a decade from now or sooner, where we have buyers interested in this business. I would say at that point, you should start thinking about what kind of trust vehicle could I create with the advice of counsel and my, if you have a family office or wealth advisory team around you, what type of trust vehicle might accomplish our long-term family goals? You know, can we start thinking through what that trust should say now and how that should be structured? And then gift a portion of the business interest, whether that's LLC membership interest, S Corp stock, you know, gift that, even if it comes to nothing, even if the business is never sold, it's never a bad idea to transfer wealth outside the estate. And to the point that Charlie made, if it's done well in advance of going to market, you're not going to have questions about, well, why is this party to the sale being added at the 11th hour? Why do we have a new signatory coming to the table? You know, it's already there in the ownership structure, old and cold, we say, of the business. And from a estate planning efficiency standpoint, a estate tax efficiency standpoint, you've already filed that gift tax return. You know, the statute of limitations is running on that. Once you sell, you know, that window may have closed for the IRS to say, well, wait a minute, there's a huge delta between the qualified appraisal that you got on the business, you know, 3 years ago versus the LOI you have in hand now or the binding sale agreement you have now. That's all that appreciation is now forever outside your taxable estate. And that exemption that you allocated to the transfer of the business interest, you don't have to add exemption to that on that delta. All that delta is free and clear outside your estate. And that's where you can see real efficiencies, you know, is the difference between the value that you secured at the date of the gift and then the value of those same interests, you know, 5 years later or whenever the sale event occurs.
Great. So in short, just don't wait till the last minute. Don't wait until you're getting really close to that valuation and as far in advance, as you said, as possible. And
Yeah,
there's no downside to having a quick conversation about it and talking to some experts.
Yeah, but I would say that if, you know, it looks like based on our polls, nobody is super close to closing on a sale. But if you were and you thought, well, gosh, we missed that opportunity, the opportunity is not lost. there's still meaningful opportunity to transfer wealth closer to having an LOI in hand or even post-closing. But where you get the most bang for your buck is when you plan early and well in advance.
All right. So Don, flipping back to that question I was mentioning about the 2 or 3 biggest drivers of value. And for the audience, just to let you know, we're going to go maybe about another 5 minutes on pre-transaction. We're intentionally spending a little bit more time on pre-transaction, especially because the question, the original question, was heavily weighted toward the poll question, heavily weighted towards people that haven't begun the process and those who have not taken any formal steps. So that's why we're going to spend just a little bit more time on the pre-transaction portion of the discussion here. And then we're going to flip into the during transaction. But Don, getting back to that valuation question, 2 or 3 biggest drivers you see in the market today, and where do people get it wrong? Where do they make mistakes and not taking advantage of what they could have taken advantage of by maximizing certain elements that could maximize their value?
Sure. Well, I think let's start with the end of that question, today's market, and what is that like? Absent 2021, which was an aberration, there's never been a better time to sell a lower middle market size business. There is a capital overhang that exists, and that capital has flown into private equity. Many of those private equity groups are under the gun to deploy that capital. Strategic acquirers are active. Cross-border international buyers are active, wanting to invest in one of the highest growth markets in the world that carries with it less risk. So the demand is there. It's really a supply question and timing question for businesses being ready and owners being ready. So I just wanted to set the stage with, there's plenty of buyers out there for good businesses. So that's number one. What's the number one thing you can have to drive valuation? Have a good business, right? Number 2 is market timing. Cover your ears, Jimmy. Cover your ears, Kelly. In a world of wealth management where diversification and non-market timing, exist and is, the right way to invest your wealth, it's not the right way to think about selling your single biggest asset. And if there isn't, if you're not insightful into when the right time to go to market is, get a good investment banker, get a good M&A advisor, because we can tell you when your industry is hot. We can tell you when it's not. And, some of that stuff isn't very revolutionary, but, you wait until your industry gets slapped with a bunch of tariffs. It's not the right time to sell your company. So market timing, and the third key is competition. I believe in the value of competition, always have. Competition brings out the best. It's bringing out the best in the world right now in the World Cup, and it brings out the best in selling a business. So that said, if you wanted to go deeper into what makes a good business, at the end of the day, in the M&A world, it is all going to be about EBITDA, earnings before interest, taxes, depreciation, and amortization. That drives everything, and something called trailing 12 months EBITDA. So the last trailing 12 months is often what a buyer is going to value a business on, or at the very least, it's going to set the cash consideration at closing. And so what is EBITDA? Well, EBITDA is a representation of having a good business. And some of the characteristics underneath that are, having a business that has historically grown and has a clear path to continue growing. And, it helps when you operate in an industry where there's a large addressable market. And so your business, has a good market share, but there's more market share to be had. And if you got a good business, you're going to take more of it. So I do think it starts with growth. I think having a high margin business and having some barriers to entry into the market is also another quality of a really good business. It's going to help you defend those high margins, and that growth in high margin is going to produce EBITDA. And then finally, something that's often overlooked and it's vitally important is, especially in today's age, business is about the people that come to work every day and leave, especially in the service industry. So having good people, having key leadership, and de-risking the business, meaning, if you've got a private business where the owner wears all the hats and that owner's ready to retire, you're going to have some problems trying to sell that business. And that goes for any type of risk. So, a professional buyer, any of the types of buyers I was talking about, is going to look for a business where it's been professionally managed, risk has been removed or is being managed. And that's the other side of the equation that drives value. And to be honest with you, Jimmy, I rarely meet an owner founder that understands that concept of risk, because guess what? They're natural born risk takers. That's how they started the business. And, it's hard for them to understand why can't this buyer just do it like we've always done it? That's just something you've got to accept. Well, if we can get to them early enough and we can point a few things out, we can't always fix those things. I mean, there's some industries, some businesses where you're going to have to live with an inherent level of risk. But if we can fix a few of those things, we can certainly drive valuation. So it all comes back to the starting earlier point.
Thank you, Don. And that's a common theme that we've talked about today. Get started early, no downside. So we're about halfway through, and our strategy was to spend about half the time on pre-transaction and then move into during transaction and post-transaction. So we're going to spend, around 10 to 15 minutes on each of those. Now, before we get into the mid-transaction process or during transaction process, Elise, do you have that next poll ready? Again, to our audience, if you click polls on the left side and then click vote now, you'll have an opportunity to pick your choice. So if you received an LOI or a letter of intent tomorrow, what would be your biggest concern? And there are four answers there. And so Don and Charlie, while everybody's answering, I'm going to go ahead and I'll give you a minute to think about it. And then Kelly, I'm going to give you, I'll share a quick one with you too. So this is for Don and Charlie. Charlie, why don't we kick off with you in just a minute. During diligence and negotiation, where do you see deals most commonly start to break down? And then for Kelly, how do you help people who are in the middle of the transaction? Because this is one of the most critical times from a planning standpoint. Mid-transaction, you have to keep people on task. You have to keep them focused. What are some of the ways that you help them stay focused on this when every day the buyer is asking for more reports, more numbers, more everything? So I'll come back to you after Charlie and Don have a chance to weigh in on where things often start to break down during diligence and negotiation. But first, I'm going to share, it looks like we're negotiating, and let's see, what would be your biggest concern? Negotiating the price in deal terms. So this question is right in line with that. So that's good. Again, it sounds like, oh, here we go. Knowing who to call first is down there at the bottom. Both of those got the same number of votes. So thanks.
And they may just be kind of two sides of the same coin, frankly. Who do you call to help you negotiate price and deal terms? But to answer your question, Jimmy, and it's a good one, of where things start to break down. And for purposes of answering the question, I'm going to assume that you've already got a signed letter of intent. And for me, there are a couple of ways that it can break down. The first is you've got the terms of the LOI, and somebody starts to really fundamentally try to retrade the deal. and addressing this audience as sellers, if you start to ask for significantly more money or for significantly more kind of deal protections than you asked for in the LOI, particularly if some of those deal protections were specifically excluded in the LOI, that's where I think you can really run into trouble. Then kind of in terms of if you don't try to fundamentally retrade the deal, what are some of the things that a buyer might see in your business that would be problematic? One of them is disputes between owners of a business. If you had 3 or 4 different people who own a business and 3 of them seem to be on the same page, and the 4th one, who's call it a 25% owner, isn't getting along with the other 3, that can be a big red flag, and a buyer may just throw up their hands and say, I don't really want to deal with this. Kind of beyond that, I think there aren't a ton of things that actually happen in a business that will cause a buyer who's already signed an LOI to walk away. But I would say that there are things that would cause sort of a fundamental change in evaluation of a business that might cause that to happen. And that's if you've got a major supplier and your contract with them is up and they try to raise the price of the whatever goods you're purchasing from them by 50%. Don talked about the importance of EBITDA. On a go forward basis, that's going to have a negative impact on EBITDA, and a buyer's not going to like that. Another thing that can cause big problems is if a buyer can't actually run back and trace through the ownership of your business. If they can't prove to themselves that you actually own it, that can be, I think, not a red flag only in and of itself, but it's sort of a red flag for kind of the organization of your business. If they see that you don't have your stuff together when you are going through probably the most important phase of your business's history, that's going to give them some pause. But I'll be quiet and let Don add whatever input he's got.
We could talk for an hour about this subject. I would just say, fundamentally, at least in the case of a high quality advisory firm working with our firm, we are going to spend a lot of time analyzing the business, organizing the business, finding out if there really are any surprises in advance before ever going to market. Because the worst thing to have is a surprise after you've selected the buyer, after you're in due diligence and the buyer finds it, right? It's okay to have a business with blemishes. Quite frankly, I haven't met one yet that didn't have one. But, finding it on the front end allows us to position it, to get the buyer comfortable with it, to de-risk it. Letting them find it afterwards is a surefire guarantee of the buyer deciding to potentially monkey with the deal, reprice the deal. So in the case of the business owners that we work with, it is rare to have those discoveries. Rarer. I like to say that, a deal's got to die at least 3 times before it gets done, but it's usually not going to be from a major surprise that we didn't think about on the front end. Quite frankly, historically, over the 26 years that I've done this, the quickest way to have a deal start to fall apart is for business performance to suffer. And if you're selling a business that is a valuable business, you're going to be expected to have a commentary on the forecast, on the future. And, we're going to be expected to put that in writing. If you want to sell something for $50 or $100 million, you're going to have a defensible forecast. And so you're on the record during the months it takes to close the transaction. And the process of professionally selling a business, if the business is ready to go to market, is a 6 to 9 month process. And due diligence, that's one thing that has changed in today's market environment, at least on the financial sponsor side. The private equity side of things, they are going to try to drag that out just to see what they can find and see if the business performance can suffer. And of course, we combat that, with our work, with the implicit threat that we could bring another buyer in if they can't get it done in a timely fashion. So, a couple of good comments there, and I'm sure Kelly's seen it too.
One other quick thing I wanted to add that I would say is a general risk is if you have a buyer who wants you to stay on with the business for some period post-closing, if you behave in a very difficult way during the negotiation process, that can be another big problem for them. Look, of course, you want to protect your interests, but on one level, I'd tell you to let your advisors protect your interests and you be the good cop. Because if your buyer sees that you are going to be a difficult partner post-closing, that can give them some pause as well.
Totally. We play the bad cop role all the time, don't we, Charlie? So, that's what we get paid to do, is try to represent our clients to the best of our ability with integrity. And that includes having some tough conversations.
Well, and I've seen that in action, especially with you, Don. I think, deals die. And then you get those
And they
paddles
come back
out,
alive.
wake them up.
Yeah,
And then
absolutely.
they come back. Yeah. And even when they're dead, they're not dead because they will come back around.
Yeah,
But-
I mean, look, a business owner that fundamentally, they've been successful because they're good at something, right? And if they excel at something, 9 times out of 10, we can get the business positioned and sold. Now, there's always going to be exceptions. One customer business is pretty hard to sell, but for the buyer that doesn't have business with that customer, it can probably get done, right? So the question is always valuation, Jimmy. I believe we can sell almost any type of asset out there business-wise, but is it going to be the right price for the owner? And so that's the real trick.
Yeah, thank you. And Kelly, the question that I mentioned before, this will be I think this will probably be our last question on mid-transaction, and then we'll go to post-transaction here in just a moment. But talk a little bit about how you have personally, so you serve clients and you have a legal background, so you do it all. So how do you keep them focused? You've got things coming from everywhere. They still have their job. They still have their day job running a company.
Yes.
But now either the
They have
strategic
2 full-time
buyer
jobs.
or the private equity wants all this it's another job. And then you're saying, focus. How do you keep that on track?
Yeah, well, first and foremost, I would say, if you don't already have a wealth advisor or multifamily office around you because you're thinking we don't need one right now because our only asset or our only asset of significance is business, so there's nothing for them to manage, I would caution you against that. There are lots of ways we as advisors can be patient on the fee side or be creative in structuring the fee schedule, even if you don't have liquid marketable securities to manage at present and your only asset is essentially the business. Waiting until after closing to engage a financial advisor, in my mind, is a cardinal sin. Like, you're losing out on all the coaching and guidance and advice, and you're not letting us tee up for the immediate liquidity event because there's going to be like huge cash drag by the time you interview advisors and engage. So by engaging on the front end, not only can we coach you through the process and, as Jimmy said, keep you disciplined, but we can also be thinking about strategies that we want to implement on day one post closing. For example, we often advise people, to the extent you have any control over the timing of the closing, time it early in the calendar year, which is counterintuitive for a lot of folks. A lot of folks think year-end closing, but if you are able to, and your other advisors agree that it doesn't sort of turn off the buyer or do anything else destructive to the deal, if you can structure it into Q1, then we have 3 quarters where we can be utilizing strategies that generate tax losses that we can harvest to offset the gains, assuming that the deal is structured as a capital gain deal from a income tax perspective. So there's lots of things we can do. We can coach you through charitable giving, both pre-sale, pre-tax giving, and post-tax giving. So we can talk about, we actually have done this twice recently with families where they give an interest in their business to a donor advised fund. It's not just any run-of-the-mill donor advised fund. It's administered by teams that specialize in this. But you give S Corp stock partnership interests to the donor advised fund. And not only do you get the income tax deduction for the charitable contribution, just as you would if you had given cash post-closing, but you don't recognize the gain on what you've given pre-sale. So we've done this twice. It's complicated because charities are not totally tax exempt. They do pay income tax on certain business interests. So you're saving on the delta between their tax rate and what would be your tax rate. But it can be done and it can be really, really meaningful. And we've coached families through this twice recently. But again, you have to be communicating with the buyer because you are bringing another party to the closing table. But these are all things that if you didn't engage an advisor before the closing, those windows would have closed. And then you find yourself sort of trying to chase some tax savings at the end of the year, which is not going to be as meaningful as if we'd had some runway to work with.
Well said. We've had a lot of charitable intent-driven clients over the years, and it really is amazing to be able to magnify that charitable intent by doing this planning in advance. Even if it makes it a little bit more complicated for us, we're highly supportive. And a shameless plug that can certainly be repaid, Jimmy, is you guys have done terrific work with many of our previous clients, both on the planning side throughout the transaction and obviously the wealth management afterwards. But the resources available, I just don't think that many business owners realize the breadth of services, and now they realize the sophistication of the partners at HB Wealth to be able to help, and it really makes our job easier.
Thank you for saying that, Don. We appreciate you trusting us with the advice that you do bring in. That reminds me, I was supposed to disclose this earlier. Charlie Yates is a client of HB. I only mentioned that because it's true. We do not necessarily recommend or endorse any panelist, of course, but we do. Charlie has a fantastic reputation of his own. But Don, when you said that, it reminded me I was supposed to. That'll make Travis happy. Okay, keep the compliance officer happy. Okay, check. So I'm going to go into the last question here, and right before we do that, I'm going to ask Elise if she'll please put up the last poll question again. Click on polls, and then you'll see vote now for post-transaction question. What worries you most about life after a sale closes? I'm going to predict we're going to get, yep. I was going to predict we would get some in those last two categories.
While you're doing that, I'll say it's even something that M&A advisors think of, or at least we do, because I've noticed over the long history of doing this, if that business owner, especially owner founders, doesn't have a plan for life after selling the business, it's amazing just how difficult it is for them to actually sell the company. I'm reminded of several owners that it feels like I meet with them once a year for the last 10 years, and they can't seem to bring themselves to step away from their baby because they don't have a plan for life after the sale of the business. I can think in particular of one incredible business that we really wanted to represent, and we did a proposal. The valuation was right, the timing was right. It was a multi-generational family-run business. Gen 1 founder came in to read the paper from 10 to 1 and would not let the son sell the company because he needed a place to come in and read the paper. And these things happen. It is a little crazy. I was like, we could take some of that money and build a whole nother building for your dad to come read the Wall Street Journal. But anyway.
And John, that brings up, I think, a larger point, which is that it is important. You've mentioned having business owners who have kind of misaligned interests earlier. And that certainly can be the case with multi-generational family businesses. And you'd like to have everybody on board the boat before you start the sale process. But I've seen more than once where you have a first generation founder who does not want to let go, and you've got children who do not want to continue to run that business. And that's evident on all sides of a deal, and it's something that can be a source of friction.
Indeed.
Yeah, and we actually worked with a family where it was the opposite. It wasn't G1 founder that was jeopardizing the closing. It was G2, because G1 thought they were doing their kids a favor, not saddling them with this business that needed a lot of time and energy to be run. And G2 didn't interpret it that way. One member of G2 didn't interpret it that way, and felt like it was a slap in the face or like a lack of trust by G1. So I think what all of this echoes or underscores is the importance of open communication among the family. Sometimes when you hear a sale, the founder owner is talking so much with investment bankers, buyers counsel. As we said earlier, it's like a second full-time job, just navigating the deal, that what you forget to do, or don't have, there just aren't hours in the day to do it, is talk with your family. What does this mean for our family once we sell this business? How is everyone feeling about it? What is everyone planning to do? Just making sure you're all on the same page, because you could find yourself at the 11th hour with people having very different feelings around the transaction. And that can blow up the deal.
Yeah,
well, thank you for just jumping right in. Go ahead.
Yeah, I would just say that, again, to turn that around, that's interesting that arose. It's more often Gen 1 thinks, Gen 2 really wants to run the business, and come to find out they really don't. And so that lack of planning has occurred, and it makes everything just a lot more complicated. So, whether it's the investment bank, the trusted attorney, whether it's Kelly's team, or they're also consultative experts that really spend their whole time consulting with family businesses, being thoughtful about, the succession plan is extremely important, which, ultimately can lead to the M&A sale process.
Sorry, go ahead, Kelly, please.
Well, I was just going to expand upon that and say, especially when it's a family business, and I would say especially even when it's a multi-generational family business and you've sort of come to the end of the road, the next generation, whether that's G3, G4, whatever the case may be, has not expressed interest in wanting to continue the business. Or in the case of like medical or dental practices, just doesn't have the credentials to continue the business. It can be a huge loss of identity. The family can have their identity so closely aligned to the profession or the industry. They can define themselves as dentists, whatever, you fill in the blank. That it can feel like you've been stripped of your identity, and it can really lead to a sort of existential crisis. And I don't say that lightly. I mean, it really is for a lot of these families. You have to navigate, what does life look like? What is my sense of purpose? What is my identity now that I don't have that, business behind me? And those are all things that the family should be talking through before the business is sold. Just to make sure everybody's aligned. And ideally exploring interests and passions and charitable pursuits before the business is sold, so that you don't find yourself sitting there on a mound of cash with no direction to go. You know, exploring passions and, you know, charitable pursuits that interest you ahead of time can give you a sense of direction and a sort of momentum once you have sold the business, and that's not your day-to-day. Those two full-time jobs you're working, running the business and navigating the sale, aren't part of your day-to-day anymore.
And quite frankly, and Charlie sees this too, it doesn't mean that, you know, your business ownership days are completely over. I mean, my goodness, I mean, how many very high net worth families, you know, took that incredible business sale and plowed it into a family office, then in turn starts doing direct investment back in privately held businesses.
That's exactly right.
So,
and that is, I mean, that is exactly what most of our families who have a big liquidation event, that is what we help them do. But again, just sort of blindly putting money, allocating dollars, signing subscription agreements for private investments isn't as meaningful as knowing what your passions are, knowing what your interests are, and using those passions and interests to guide your investing going forward.
And one sort of legal consideration on that front is, if you sell your business, you are going to sign a non-compete along with some other restrictive covenants. That is one of the things we can help guide you on post-closing. It's also something that we can help you with during the transaction to an extent, but you know, you are not going to get out of signing some form of non-compete, because if somebody's paying you a boatload of cash for your business, they don't want you to then go and invest that cash to compete against them and use your expertise to undermine what they just bought. So be aware of that. And if you're not ready to sit on the sidelines of your business for a little while, then don't sell it yet.
And along the same line, Charlie, that's very well said and a great point. But oftentimes, again, depending on who the buyer is and how it's structured, part of the deal arrangement might be that the executive team stays on for a number of months or years. And that might be tied to earnouts and other incentives. So along the same lines of mentally preparing yourself to sit on the sidelines, you may have to mentally prepare yourself to sit in your office working for someone else, which is not palatable for a lot of folks, or not, it takes some adjustment.
And that's why you need Don to help you find a good buyer who you like.
absolutely. It's a big piece of what we do is thinking about on the front end, the buyer types, right? And really helping educate that ownership team on what would life be like post-sale if we sold to a private equity group, if we sell to a strategic buyer, if we sell to a family office. And, you know, sometimes that can certainly alter our marketing plan. You know, I am generally an advocate of a broader process, and the size companies we work with, we typically work our fannies off. It could be like 200, you know, buyers deep that we are marketing to in a thoughtful, researched way, dealing with these buyers to have a mix of private equity alternatives and strategics, and let the owners see the contrast there, and really up close and up front see what their valuation is, and see what life is going to be like if we were to sell to that buyer. That's a big piece of what we do in our work.
I feel like if we let the conversation keep going, we would be here for quite a while, which is wonderful. And I love the way the last portion of the conversation just took off organically. I didn't even pose a question, but you just did a wonderful job. Thank you for jumping right in and leading. I could have left and, you know, gone to a meeting or something. Y'all would have just taken off.
It's the best commentator possible, right?
Yeah, exactly. It's a great panel, a great topic. Thank you all. Thank you, Kelly. Thank you, Charlie. Thank you, Don. We appreciate your service on the panel today. And thank you for all of your wonderful and valuable insight.
Delighted to serve. Thank you. Bye-bye.
Thanks, everybody.
Guys, thank you.